Assalamualaikum and hi everyone. Welcome to Principal Malaysia's 2023 Quarter 4 Market Outlook. I'm Fartini and I'm your moderator for the session today. I'm delighted to introduce our speakers. They are Patrick Cheng, CIO of Principal Malaysia and CIO Equities of Principal Southeast Asia, Jessie Liu, CIO Fixed Income of Principal Southeast Asia, and Lee Chun Hong, Head of Equities of Principal Malaysia. Patrick, how are you?
Very good, thank you.
Okay, Patrick. Looking back the past 3 months, the global equity markets seem resilient except for China. Now, can you give us your perspectives of this situation, particularly in the context of developed markets versus Asia-Pac ex-Japan equities?
Right. Thanks for that. I think just to recap, year to date itself, equity markets, especially in developed markets, have done very well. Whether it's the US market, up 70%, the Nasdaq up 40%, and Europe and Japan as well, right? Of course, nearer to home, the Asia and Japan is up only about 3%. We can talk about it a bit later. But I think ultimately what's happened in the quarter today has been a very surprise calm, right, in markets itself, where most markets have been very flat, including China. And China to us was a bit of a surprise, largely because I think there is some form of more policy measures being announced. We can discuss that a bit later. But I do believe at the end of the day, we are sensing that people are starting to forecast milder recessions, rate cuts being put on hold, and maybe a later part of 2024. But all of these are suggesting that the recession that we anticipated is going to be less deeper than anticipated. And I think calmness in equity markets are being priced in as we speak.
Okay. Thank you, Patrick, for your perspective. Now, let's move to Jessie. Jessie, what's your take on the fixed income markets? How has it been doing in the recent months?
Right, thank you for the question. So, when we look at fixed income market between developed markets and developing markets, I think it's very important to realize that over in the developing markets, you have probably a lot less policy rate movements as compared to the developed markets. So, when we talk about performance, because of policy rates, you will see developing markets performing fairly well as compared to developed markets. So if I were to just reverse back in terms of first quarter performance, in the first quarter of 2023, we had really sharp rises throughout the whole world when it comes to fixed income. But it was because everyone had that mindset, like what Patrick mentioned, that there's a hard landing is going to come. And because of that, rate cuts might also come. But what market is seeing as they enter the second quarter is that that's not the case. And everyone is actually changing that narrative now from a hard landing to a more soft landing or even no landing. That's the new term that came out. So when we have that kind of situation where economic activity is much more resilient, the developed market then had a little bit more volatility. There were a few more hikes coming out from the US, from Euro, from UK, because inflation was just too high or not coming down as fast as they hoped. And because of that, performance really did hit developed markets in that sense. First quarter of the year, we had most of the indices positive returns. Second quarter of the year, that kind of wiped it all out. And net for the full year, for a year to date until August, we are looking at shorter duration strategies making money, whereas the longer duration or longer interest rate risk portfolios garnering negative returns. Now, the unique part is that because in ASEAN, or specifically Malaysia, you don't have any policy rate risk. We continue to see positive returns, and year to date, Malaysia, if I'm not mistaken, is there about 5% at this point in time.
Okay, interesting. Thank you so much for that, Jessie. Now, Patrick, given what you just said earlier, that developed markets continue to outperform Asia, do you see this trend continuing, especially when it comes to artificial intelligence or technology theme? What could derail this momentum, if any?
It's a very good question. The simple answer is that I think developed markets, as you know, have done very well, especially on the tech sector, right? And I think that the AI movement that we talk about is a long-term structural story. That's a given, right? But I still think that investors out there need to be a bit more cautious to overprice this. So I'm a bit more cautious on certain selective sectors of the technology sector. I do believe that given the fact that it's outperformed quite a lot this year, one has to take the view of what relative value is. And I think the relative value is in Asia, is in ASEAN, and maybe even in Malaysia itself, right? Where you can get exposures to, supply chains, for example, through the AI and so forth, through the EV manufacturing, and also basic material sectors, which I think are also part of this whole technology movement that we talked about earlier on.
Okay, thank you. Now, my next question is for Chun Hong. Chun Hong, can you give us an update on the current sentiment in the Malaysian market? Are we seeing increased foreign investment, especially after the recent announcements of the new energy transition roadmap and new industrial master plan 2030?
Thanks, Fatini. Thanks for the question, especially on Malaysia. So Malaysia has been a lost child for a while. I mean, started off with 6 months of consecutive selling in Malaysia. And since end of June, the market in Malaysia has really outperformed the region by 7% since then. And also coincide with the following inflow. So we started to see inflow from July, August, and yet month to date as well. Largely because of the announcement, a series of announcements by this Mandarin government, the National Energy Transition Roadmap, then followed by the new industrial master plan, and recently concluded midterm review on the 12th Malaysia plans. Of course, the just concluded 6th state election also helped the sentiment. Yep. So yes, hopefully that momentum continue and Malaysia start to shine again.
Okay.
Yep.
Yeah. Thanks for that, Chun Hong. Let's discuss the Asia-Pacific region. As we approach the end of the third quarter, market performance seems somewhat subdued. Additionally, China's macro outlook has been less than stellar despite government support. So Patrick, what's your insights on this situation? Do you see any potential improvements on the horizon?
Short answer is yes. I think the Chinese government over the last month or so have been very, very busy. They do acknowledge that there are some structural issues in the Chinese economy, both on the consumer sector, the property companies, and largely also selective, manufacturing companies as well, right? So I think they are taking steps. You've seen over the last few weeks, they have cut rates by 20 basis points. They started to move towards giving more constructive policies towards the property sector. They're giving positive guidance on the private sector as well. All of this is supportive of trying to encourage investments and consumer confidence to come back. Now, I think the real debate out there is whether or not this is enough, and we are waiting for more. And investors like ourselves want to see more concrete plans towards this, because the last thing we want is to see a more structural decline in the economy. And I think the danger of not stimulating the economy at this juncture itself will lead to repercussions longer term, and that's something that we are quite concerned about. But I suppose, in a nutshell, in short term, I do believe that the Chinese government is pressing the button on trying to make sure that they do what is necessary, but I think more needs to be done.
Okay. So we're going to go back to fixed income, yeah? So Jesse, what are your thoughts on future policy rates globally and in Malaysia? And do you foresee any potential impacts on fixed income assets?
Okay. So we start with Malaysia. I think it's the easiest of the lot. I think policy rate movements would stay pretty much at where it is today. There are a few reasons behind that, one of which is because our inflation is not as volatile, and that is because we do have subsidies that is in very key commodities inside the country, and that helped a lot in terms of anchoring inflation as we move forward to the year. But if you look into developed markets, that's not the case. And for example, if we look at into UK, they are still stuck at a very high inflationary kind of an environment. So if I were to look into developed markets and developing markets, I think developing markets will probably have lower risk when it comes to policy rates. Developed market a little higher, and specifically if we are talking about a US, Europe, and UK, I think the risk is probably more on UK and Europe, followed by the US. Inflation itself is trending down again, but it's not trending down as fast as possible. And what is important to also note is that at the end of the day, these central banks, they do have a target, and their target is typically around 2%. And they are a little bit far off from that 2%. And because of that, I think if there's any risk of rate hikes, it will be probably from these developed markets. Now, having said that, we need to take stock of how much policy rate has already hiked throughout the world. So again, in the US, we came from 0 beginning of last year until today. It's 5% of hikes already. We can come into a situation that even though inflation is coming down slowly, there is a risk of movement in terms of policy rate, but I don't think that movement will be similar to last year. So what I'm trying to say in gist for developed markets, maybe we are looking at the tail end of that, that peak cycle already. So it's just something that we are watching out at this point in time.
Thank you, Jesse. Junho, we're going to go back to you now. Let's hear your perspective on Southeast Asia. We know that the region has offered investors some portfolio defensiveness against the global economic slowdown and US-China trade tensions. Are there any other potential catalysts that could further drive the performance in the region? And also, do we anticipate the peak in the USD to provide additional upside potential?
Okay, thanks. So continue from Jesse. I mean, the rate hike is coming to the tail end. Generally, that is good for the ASEAN currency as well, and also the emerging currency. And secondly, generally ASEAN market perform best in the fourth quarter and the first quarter of the year. So we are entering a strong seasonal trend now for ASEAN markets. So coupled with the stable policy rates, stable government, except for Indonesia, which is facing an election next year. So we don't see any external risk coming to ASEAN the next 12 months. So cheap, high dividend yield, and stable growth will position Malaysia ASEAN market well when the developed market are slowing down the next 12 months.
All right, thank you for that. Now, as we wrap up today's discussion, let's get some advice for our clients regarding near-term asset allocation. Patrick, let's start with you, and then I will hear from Jesse.
Yeah, I suppose from an equity point of view, it remains to be seen whether or not developed markets will continue to outperform, particularly when we enter a period where there are some recession risks, although it's mild, right? So I'm a bit more cautious on that front. That's the first point. The second point is that, as mentioned early on, in the short term itself, when you get reverberations from the Chinese market, people need to asset allocate. And I think the asset allocation call that we have this particular quarter is to gravitate towards the ASEAN markets, which, as mentioned by Chung Hong, is defensive. There's a lot of catalysts, for example, like foreign direct investments, going into ASEAN, particularly like Vietnam, Malaysia, and Thailand. I think these are structural stories that not a lot of people really understand. But I do believe that there's going to be something which is going to be tailwinds for the markets. And I do believe at the end of the day is within the ASEAN space itself, one interesting market which Chung Hong mentioned on is Malaysia, right? Malaysia basically, I suspect is going to be a comeback hit, right, as I call it. It's very cheap. The policy being made by the government today is very, very positive, especially on NATR. Johor is the center of a lot of part of this NATR, where data centers are being built, property market is getting more vibrant. And I suppose if you put that all in a nutshell, that if you need to have exposure in Malaysia, I would suggest that you look into our small cap funds as well as some of our balanced income funds, which give you a balance of both income and growth, as well as if you have appetite towards growth, you want to buy into most of these growing companies which have leverage towards the themes that we talk about, either NATR or FDIs and so forth.
Thank you for your insights. And now Jesse.
So I think towards the end of the year in 2022, our call was to overweight local currency fixed income, even more so than US dollar fixed income. So that kind of played out well for us. So if we move forward, I think we still hold that stance. We still think that local currency fixed income like ringgit will still perform well, largely because we have more visibility in terms of policy rates. But having said that, I think developed market fixed income is also starting to get really attractive because of the rate hikes that's been coming in already. So the only question here really is that, do you see that tail end immediately or not? If you don't see that tail end, then chances are developed market like US dollar fixed income can still be invested because the short end of the curve has a very high yield positioning into, has a very high yield nature to it. So in that sense, if you want to invest in developed market, I would say it's still more towards a neutral kind of a positioning in terms of duration. Don't get too long. That should work out fine, and then you don't have to really crack your brain trying to time the market and so on and so forth. Malaysia itself, I think we still like to have a little bit more duration playing. Again, our curve is upward sloping, so if really growth does slow down a lot, and if rate cuts does occur, then obviously the long end of the interest rate curve would rally first. So yeah, I think that would be a positioning for us for Malaysia.
Okay, thank you, Jessie, for that. Now, on that note, I'd like to thank Chun Hong, Jessie, and Patrick for their insights and perspectives today. And to everyone watching, we hope that this quarter's market outlook has provided you with some valuable insights, information to help you manage your long-term goals. Thank you, everyone, for watching. Till next time, stay safe and be well.